It's that time of the week. Talk to our buddy Zach Abraham, Chief Investment Officer, Bulwark Capital. Talk about the economy. All right, brother. Right out the gate, GDP. They revised it. Should I believe these numbers?
You know, sure. GDP numbers are so, especially when you look at the way they're tabulated, they can be so misleading. So what I tell people all the time is, whether you see revisions up, down, whatever the case may be, what you're really looking at for on the GDP side of things to see if there are any big shock changes. Because we live in a click world, right? Getting clicks. Everybody's going to try to dress them up and make it sound more exciting than it is. Especially in an environment like this, I would expect GDP to be very loud, very noisy. That's what we're seeing. But you're not seeing any, it's kind of funny to hear everybody talk about, oh, look at the size of that revision. And you're sitting there going, well, that happens all the time. And when you think about the craziness and the variability that tariffs have thrown into everything, when you think about what's going on with China and how China's trying to rapidly, get exports going to other countries other than the United States to help. There's so many different things shifting around. And so I think GDP reports, as always, need to be taken with a grain of salt, but I'd say even more so right now.
So speaking of tariffs, and I've been debating this, it's going to the Supreme Court. Let's just say, for the sake of argument, they said, dude, you don't have this is not your purview. This is Congress. They're the ones who set tariffs. Your emergency that you used is not something that can be used for this. That money's got to go back. That throws everything sideways. What would that do to the market?
I don't know. That's a really good question because I think what you'd probably see is a sell-off in the dollar. You would probably see some market volatility, but then that would be offset by the markets breathing a sigh of relief about not having to worry about tariffs any longer. But I'll tell you what, I am not a tariff law expert by any stretch of the imagination, nor am I an international trade expert. But based on our readings of the rules and laws, I would be very shocked if the ruling comes back. Now, I wouldn't be shocked if they curtailed some of those powers or curtailed some of those orders or some of those tariffs.
Made it a little bit more narrow in certain ways.
Maybe, but it's when you start looking at law, when you start really examining these things, I think it's a really tough argument to make that via precedent, right? Which is what people I don't think pay enough about. Precedent is such a big deal in our system, and the president does have the ability to impose tariffs. Now, if they go over a certain level, you've got to get Congress to come in there and do their thing as well. But it's happened in the past. There's precedent for it, and I think that is going to be right. And I'm not sitting there arguing that the Supreme Court should do one or the other. What I am saying is I would be shocked if that's the ruling they come back with. But in this environment, I mean. We should probably caveat the word shocked, right? Yeah. Because
it's all over the place. Talking Zach Abraham, Chief Investment Officer, Bulwark Capital. I read an article today. I think it was in Fortune or was it Forbes, one of the two. I think it was Fortune, talking about it is the most uncomfortable bull market out there. I feel like everybody's waiting for a pop somewhere.
Yeah, well, so here's the funny thing. I keep hearing people say that. And yet when we examine the data, you have never had more levered long positions. You have never had the options market as insanely bullish as it is. So now short term, I will be shocked if we don't see some substantial volatility here in the next month. And I am not advising anybody to do anything. I will just let you know that we've been building hedges into our portfolios for the last week, just because there's so many things. Look, whenever I see moves like this, I don't know if you paid any attention to this, but Nvidia just announced that they are going to invest $100 billion in OpenAI. OpenAI is going to turn around and use that $150 billion to buy Nvidia chips. Okay. This is what we used to call back in the day revenue sales, right? You're just engineering revenue. And I thought somebody had a really good one where they showed a power strip, but instead of the power strip being plugged into the wall, it was plugged into itself. you know? And I think that that is a very, very important thing to pay attention to, because here's what I can tell you for certain. Nvidia would not be doing that if internal demand is what they said it was. And the reason they wouldn't is because it's not as right. It's not as profitable. It's more cumbersome than just selling the chips outright.
Yeah.
So what we think is going on actually is China came out last week and said no more Nvidia chips. Within 48 hours, that news of the OpenAI deal came out, right? So we estimate that China's probably soaking up about 30% of that demand globally. You're not going to make that up, right? And here's the issue. And I don't think, look, and none of this means that Nvidia is about ready to collapse, or Nvidia is an unbelievable company. They're going to be here for a really long time. Their valuation, though, right? This is, you and I have had this conversation. The valuation, if we pull back revenue estimates over the next 5 years by even 15 or 20%, that stock's probably going to take a 40% header because it's so richly valued, right? The other thing we got to think about is if China says they don't want any more Nvidia chips, that means that they've got something that does the job, right?
Yeah,
that's going to take a dent in Nvidia's stuff. So I hear people saying that they think the market is really vulnerable, but when you look at the way investors are positioned, it's very aggressive. It's historically aggressive. And you've seen these moves. The reason we're getting nervous is Nvidia went up like 5% on that news. That is not good news.
Which is crazy.
Right. It shouldn't have made their stock plummet, but what it should have done is made everybody step back and go, wait a second, why are they trying to engineer demand by paying somebody $100 billion to buy their chips?
Yeah.
Right. That doesn't even make any sense.
Why is your stock going up when you just lost a huge client, if you will, in China saying we're not buying your stuff? And everybody's like, we should buy more Nvidia.
Yeah, and that's and honestly, that's what really worries me, because I think two things are driving it. And I can tell you, as a guy that manages money, I'm sympathetic to both things. But I think two things are driving it. A, you have more uneducated amateur investors operating in this market with record amounts of leverage than you've ever had by far. But B, you have more money managers than ever in history that are scared to death to not be long US big cap tech. Right. And the reason they're scared to not be long US big cap tech is the same reason we're afraid to not be long US big cap tech, because it's rallied for the last 15 years, regardless of what was going on. Right. So, I mean, it's really been the only, unbeatable or unsinkable ship out there in the market that's really muscled through everything. And so when I start seeing moves like that, and you got to put people like, Zach, that's 5% Nvidia. That's not a big deal. What's 5%? You go, well, guys, 5% of a $4 trillion company is $200 billion, or 2x their annual profit. And that's the other thing that's starting to freak me out, is when you look at these companies at this size, right, at these valuations, you start looking, well, I think the stock's going to go up 40%. You think the stock's going up $1.5 trillion? Right? In the next how many days? You know what I mean? Like, people are losing track of the numbers.
Yeah.
And so let's say Nvidia boosts profits by 20%, 20 billion. That should add another 1.4 trillion on their market cap. You see, and so this law of large numbers is really starting to become kind of what I think is sort of a sword of Damocles hanging over the top of the market, which is, look, sooner, I'll just tell you right now, these valuations aren't going to hold. When they pop, I don't know. But that's, those deals, you think back to 99, think about 2000, 2001, think back to 07, 08, 09. You always have these telltale signs, these canary in the coal mine type moments. And when the darling, the profit machine, unlike anything the world has ever seen, when they're engineering $100 billion deals to increase sales, I can't help but to think that that's a bit of an alarm bell going off saying, hey, look out, right? Because if it was really that good, why are they doing that?
Yeah, no doubt. It's crazy. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. There's the internals of the economy and this, that, and the other. But I think one thing, and I talked to a couple of people this week about it, the externals. The world feels a little bit on edge right now. And you've got, all of the admirals and all of the generals going to meet with Hegseth next week. You've got, there's no doubt that Trump, his relationship with Putin is hit the rocks. And, I wonder, stuff gets spicy. The market is, it moves out of spiciness. That's some, have they built anything into that, or would that catch everybody right in the shorts?
I think there's so many things. Here's the catch, though. Here's the crazy part about it. You think about all this stuff going on, you still have the volatility index, the VIX trading at like 16, right? So insurance is cheap. That's the crazy thing, is nobody thinks they need it. And so there's any number one of these things that could go off. And here's the thing that makes it so, or potentially pernicious and kind of freaky, is what could typically happen. It's not just the event, right? It's what the event makes people say. And when events like that occur, people start taking a much closer look at what they own. And they start thinking to themselves, you know what? Should I own Palantir at 600 times earnings? Should I own Nvidia at 25 times revenue? Is that a good idea? Do you know what I'm saying? It's kind of one of those things that it was kind of like how
stock and stuff that you think, you know what? I've done okay here. I don't know if I need to hold on to this thing forever.
Yeah. And it's all of those stocks at the top of the market, the FANG stocks that everybody owns way too much of. So if everybody starts trimming those positions, it could get nasty in a hurry. And one of the things that freaks me out, the message that I'm trying to get to investors, our value portfolio is up more than 29% this year. And we own barely any of that stuff. And the reason it's up is because of all the value that's out there, the gold mining stocks, the silver stocks, we picked up some Chinese equities a few months ago, and that's just been a rocket ship higher. And even though it's been a rocket ship higher, they're still trading at a 50% discount to US equities, right? So the thing I'm looking at people is going, you're playing with fire and you don't need to. You're investing in things that don't make economic sense, meaning great companies, but like Buffett says, there's no such thing as bad assets, just bad prices. And there's just a bunch of bad prices out there. So I'm sitting there going, I think the average American investor is making this way too hard, right? Buy the value. Quit, don't sit there. Don't just chase trends. That's worked for 15 years. Now you're sitting here looking at a market where tech isn't anywhere close to being the best performing sector this year. The United States isn't anywhere close to being the best performing market. And I think those are trends that are going to continue. And the reason I think they're trends that are going to continue is just go look at the fundamentals of so many of these economies, so many of these businesses that are not at the end of a 15-year run. They're emerging from 8 to 12 years of just nasty, right? So you've got depressed valuations, you've got earnings troughs, you got all the stuff that guys like us that are value guys that recognize it are just licking their chops, right? You show me an environment where the S&P is trading at 33 times earnings, and I can go all over the place and find companies that are growing revenues by 20 to 30% and trading at 6-7 times earnings. I mean, sign me up. Yeah. But everybody's afraid not to be long those things, and it's killing their performance this year. And we're just sitting there going, hey, guys, the times they are changing, and you got to change with them. The U.S. market is not going to dominate for every year going forward for eternity, right? It's just, that's not the way this works.
Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. All right, let's talk about your webinar. You got it coming up next Thursday. Tell everybody about it, how they can join.
Yeah, pretty easy. It's free. There's not a sales pitch. We're not going to hustle you. If you don't want to speak to one of our advisors, you're never going to hear from us again. And just go to bulwarkcapitalmanagement.com. We walk you through our process, who we are, what we do, why we do it, what sets us apart. We explain to you that we're active managers with traders and analysts on staff, which make us very different than most firms. But we explain what all that means and just show you what we do and how we do it. And you're going to leave there with a good understanding of who we are and how we do things. And like I said, if that's as far as you want to go, great. We're not going to call you every Saturday for the next 5 years. You won't hear from us. But if you do and you're interested, then you can have a conversation with me or one of our advisors, and we'll get you squared away.
Rock and roll, brother. Good to do it. Let's do it again next week.
Sounds good. Thanks for having me.